The inflation number just came in lower than expected, and gold, which is supposed to fall when inflation cools, did the exact opposite. It jumped, climbing to its highest level in nearly 3 months within hours of the report. If that makes no sense to you, good, because it means you are paying attention. And it means you are about to understand something that the people who sold their gold this morning completely missed. There is a single word that explains why gold rose on news that should have heard it. A word that has not seriously frightened the American economy in over 40 years. And today's numbers just whispered it out loud for the first time in a long while. By the end of this video, you are going to know that word, understand why it is the one thing that terrifies the Federal Reserve more than inflation alone, and see why gold, quietly, is the asset built for exactly the trap the economy may now be walking into. And I am going to give you that word right now at the start, instead of holding it back, because everything else depends on it. The word is stagflation. It is the ugly combination of two things that are supposed to be opposites: a stalling, slowing economy on one side, and stubborn, sticky inflation on the other, arriving together at the same time. Normally, when the economy slows, prices cool off too. And when prices run hot, it is because the economy is booming. Stagflation is the nightmare scenario, where growth dies but prices refuse to. And it is a nightmare specifically because it leaves the Federal Reserve with no good move to make. And today's data, a cooling in inflation, paired with a clear slowing in economic growth, is the first real whisper of that word returning. That is what gold heard this morning. That is why it jumped. But before I go further, I want to know who is in the room with me right now. Tell me in the comments where in the world you are watching from, and tell me honestly what you are holding. Gold, silver, cash, stocks. Tell me. Because the word I just gave you affects each of those very differently. And the mix of your answers tells its own story about how ready this audience is for what may be coming. And I promise you I will come back to what those answers mean before we are done. Let us start with the numbers themselves, plainly, because they are the evidence for everything that follows. This morning, two reports landed together. The first was on inflation, the government's preferred measure, and it showed prices cooling. The annual rate easing back from where it had been. On its own, that sounds like unambiguously good news. And for the stock market, it partly was. But the second report, released the same morning, showed the economy growing at a rate of just 1.5%, down from over 2% in the prior period. The engine is slowing, and it is that combination cooling prices arriving alongside a cooling economy that raises the specter of the word I gave you. Not inflation alone, not recession alone. The uneasy shadow of both starting to appear at once. Now, to understand why this matters so enormously for gold, you have to understand the trap it sets for the Federal Reserve, because the Fed is the machine at the center of this whole story. The Fed has essentially one main tool, the interest rate, and it has two jobs that usually do not conflict. When inflation is too high, it raises rates to cool prices. When the economy is weak and jobs are at risk, it lowers rates to stimulate growth. In normal times, it faces one problem at a time, and it knows which lever to pull. But stagflation breaks the machine, because now imagine both problems at once. Inflation is still too high, which screams at the Fed to raise rates. But the economy is slowing, which screams at the Fed to cut rates. The two alarms ring at the same time, demanding opposite actions, and there is no single move that answers both. Raise rates to fight the inflation, and you risk crushing the already weakening economy into a deep recession. Cut rates to save the economy, and you risk letting inflation roar back out of control. The Fed is trapped between two fires, and there is no exit that does not burn. And here is the chairman's particular version of that trap, because it makes today even sharper. The man running the Federal Reserve right now is a committed inflation hawk. Just yesterday, his committee held rates steady, but 3 of its own members broke ranks and demanded a hike. And the chairman himself delivered a defiant message, declaring the Fed would not waver in its fight against rising prices. He has planted his flag firmly on the inflation side of the trap. But today's slowing growth number is the other fire flaring up right behind him, the one his tough talk does not address. A hawk determined to fight inflation, standing in front of an economy that may be buckling, is a portrait of exactly the impossible position stagflation creates, and the markets can see it. If you are finding this useful already, take a moment to like this video and subscribe, because now I'm going to show you why gold, of all the assets in the world, is the one built precisely for this trap, and why it behaved so strangely this morning. Here is the answer, and it is the heart of everything. Gold thrives in stagflation for one simple reason. It is the asset you turn to when you have lost faith in the people managing the money, and stagflation is the exact condition that destroys that faith. Think it through. In a stagflation, holding cash is punished because inflation is still eating away its value. But holding stocks is also punished because the slowing economy is crushing corporate profits. Bonds struggle too, caught between the inflation eroding their fixed payments and the uncertainty over rates. Nearly every traditional safe harbor has a hole in it, and into that vacuum steps gold, which owes its value to no company's profits, no government's promise, and no central bank's competence. It simply is what it is, a store of value that has outlasted every currency and every crisis in recorded history. When investors sense that the Fed is trapped, that there is no clean way out, they reach for the one thing that does not depend on the Fed finding an exit. That is why gold rose this morning. It did not rise because inflation cooled. It rose because the whole picture, cooling prices plus slowing growth, whispered that the trap may be closing, and gold is the classic escape from that trap. Let me make this real with two people, because these forces only matter when you see how they land in a life. Neither is real, but both are the kind of person you might recognize. The first I will call Theo, 63, a retired teacher. And Theo has spent this year in a slow, quiet agony over his gold. He bought some a while ago, watched it fall through the difficult months, and every time it dropped, the loss gnawed at him far more than any gain ever pleased him. This morning, when the inflation number came out lower, his first instinct was relief and a thought, maybe now I can finally sell this disappointing gold and be done with the stress. He was, in that instant, ready to sell the very asset built for the storm he does not yet see coming, purely to make the discomfort of his paper loss go away. Theo is not foolish. He is human, and he is about to make a decision driven entirely by the pain of a loss rather than by any understanding of what today actually meant. The second person I will call Miriam, 65, and she is not richer than Theo and not smarter about markets. She simply learned to separate the discomfort of a falling price from the meaning of the underlying situation. When she saw cooling inflation land alongside slowing growth, she did not think about her paper loss at all. She thought about the word stagflation, and she understood calmly that this was precisely the environment her gold was meant to weather. So where Theo felt an urge to flee his gold to escape the ache of the loss, Miriam saw the storm clouds her shelter was built for finally gathering on the horizon. The difference between them is not knowledge. It is that one of them is ruled by the pain of a loss, and the other reads the situation for what it is. Now, why is Theo's instinct so powerful and so common? Why does a paper loss gnaw at a person badly enough to make them abandon the right asset at the wrong moment? The answer is one of the most important discoveries in the science of human decision-making, and understanding it is genuinely the most useful thing I can give you today. Researchers found, through decades of study, that human beings do not feel gains and losses equally. The pain of losing a certain amount of money is roughly twice as powerful as the pleasure of gaining the very same amount. Losing $100 hurts about twice as much as finding $100 feels good. This is called loss aversion, and it is wired deep into us, a survival instinct from a world where a loss could mean death, while a gain was merely nice to have. In the world of investing, though, this ancient wiring becomes a trap of its own, because a paper loss, the sight of your holding worth less than you paid, generates a pain so disproportionate that people will do almost anything to make it stop, including selling a sound asset at exactly the wrong time, just to end the ache. Theo is not weak. He is feeling at double strength, a pain his brain was designed to treat as mortal. The investors who succeed are the ones who recognize that double pain for what it is, an ancient reflex, and refuse to let it make their decisions for them. And silver deserves its own word here, because in a stagflation it faces a genuine tug of war that gold does not, and understanding it matters if you own it. Silver has two identities at once. It is a monetary metal, a store of value that responds to the same collapse of faith that drives gold. And in that role, stagflation lifts it just as it lifts gold. But silver is also an industrial metal, more than half of its demand coming from factories, from solar panels and electronics and electric vehicles, and in a slowing economy, that industrial demand can soften. So silver's pulled in two directions at once by the very same stagflation, upward by its monetary role and the flight to safety, and potentially downward by the industrial slowdown. This is why silver tends to be the more volatile of the two, swinging harder in both directions, the more energetic and less predictable cousin. In the stagflation of the 1970s, silver ultimately soared even more dramatically than gold in percentage terms, its monetary side winning out spectacularly. But the ride was wilder and the drawdowns deeper along the way. For the saver who can stomach that turbulence, silver can amplify the move. But it is not the steady ballast gold is. It is its own animal with two engines that do not always pull the same way. And stagflation is the exact condition that sets them at odds. Now, let me be honest and careful with you, because I will not insult you with fear. And this subject draws people who want to frighten you into acting. One morning of data is not a declaration of stagflation. It is a whisper, not a verdict. It is entirely possible the economy reaccelerates, that inflation keeps falling cleanly, and that the word I gave you fades back into history, where it has mostly slept for 40 years. Gold has had a hard year, well below its January peak, and it can certainly fall again. Anyone who tells you stagflation is now certain, or that gold is guaranteed to soar because of one report, is guessing and dressing the guess as knowledge, and they deserve your suspicion. What I am giving you is not a prediction. It is an understanding of what today's numbers hinted at, and why gold reacted the way it did, so that whatever unfolds, you can read it clearly instead of being ruled, like Theo, by the pain of a paper loss. Let me give you something practical. Then, a way to watch this going forward. The single most important thing to track now is whether these two trends continue together. Watch the growth numbers and the inflation numbers side by side. If growth keeps slowing while inflation stays stubbornly high, the whisper of stagflation grows into something louder, and the Fed's trap tightens. And that has historically been powerful fuel for gold. But if growth stabilizes and inflation keeps falling cleanly, the trap never fully closes and the pressure eases. Do not watch either number alone. Watch them as a pair, because it is the combination, not either one by itself, that spells the word that matters. Now that you know to watch them together, you are reading this economy at a level most people never reach. And here is the piece that puts all of this in its proper place, the piece I most want you to carry away. While ordinary investors agonize over every data release, the largest and most sophisticated buyers on the planet, the central banks of entire nations, have been quietly buying gold for years, steadily at a pace not seen in generations. They bought a net 244 tons in the first quarter of this year alone, and the highest share in the history of a long-running survey of these institutions say they intend to keep buying. Think about what that means. The most informed money in the world is accumulating gold. not because of any single morning's numbers, but because they see more clearly than anyone the long-term trap the entire system is caught in, a world of enormous debt, strained growth, and central banks with fewer and fewer good options. Today's stagflation whisper is a small daily echo of the very concern driving their vast patient buying. When you feel the urge to flee your gold, like Theo, remember who is calmly on the other side, buying what the frightened are selling, and ask what they understand that the panicking crowd does not. There is a deeper force underneath all of this, too, and it is worth understanding. The United States government now carries a national debt of more than $39 trillion, with the interest bill alone past $1 trillion a year. This is what makes the stagflation trap so much more dangerous than it was the last time the country faced it. Because to truly crush inflation, the Fed would need to raise rates hard and keep them high. But doing so on a debt this size would blow a catastrophic hole in the government's budget and would risk breaking the very economy it is trying to save. The debt is the reason the Fed's trap has no clean exit. It is why many sophisticated investors believe that, faced with the impossible choice, the authorities will ultimately choose to tolerate more inflation rather than crush the economy and the budget together, quietly letting the dollar weaken over time. And a slowly weakening dollar is precisely the long, slow environment in which gold has historically preserved its value while paper money bled its away. The trap the Fed faces today is not the trap it faced in the 1970s, because back then the national debt was a fraction of what it is now, which means the room to fight inflation with brutally high rates simply does not exist the way it once did. The debt has quietly changed the rules of the game, and it has changed them in gold's favor. There is history here too, and it is the most important part because we have seen this word before and we know what it did. Go back to the 1970s, the last time stagflation truly gripped the American economy. Growth stalled, unemployment rose, and yet prices climbed relentlessly. The exact impossible combination whispered by today's data. It was a miserable decade for ordinary savers and for the stock market, which went essentially nowhere for years in real terms. But gold over that same stretch rose from around $35 an ounce to over $800. An extraordinary climb, precisely because it was the one asset that answered the very problem stagflation created. A collapse of faith in paper money and in the institutions managing it. The lesson is not that history will repeat exactly, because it never does. The lesson is that gold's strange behavior this morning, rising on news that should have hurt it, is the same behavior it showed the last time this word stalked the economy. And back then, that behavior was the early signal of one of the greatest runs in the metals history. So let us pull it all together and go back to that word I gave you at the start. Today, inflation cooled, but the economy slowed alongside it, and gold, rather than falling, jumped to a near 3-month high. That reaction makes no sense until you see the word underneath it. Stagflation, the impossible combination of a stalling economy and sticky prices that traps the Federal Reserve between two fires with no clean exit. Gold rose because it is the classic escape from that exact trap. The one asset that does not depend on the Fed finding a way out. The chairman has planted his flag on fighting inflation, even as the growth number flares up behind him. A portrait of the impossible position this word creates. And through it all, the central banks of the world keep buying gold, calmly, for reasons a single morning's data cannot touch, while a mountain of debt quietly ensures the trap has no painless exit. So here is what I want you to carry away, framed as plainly as I know how. Today was a whisper, not a certainty, and neither I nor anyone else can promise you where this leads. But the whisper matters because it named the one condition in which gold has historically done what no other asset could. And the way gold reacted this morning suggests the market heard that word clearly. If you hold gold as protection against a world of staggering debt and trapped institutions, then a day like today, when gold rises on news that should have sunk it, does not weaken your reason. It quietly confirms it. This does not mean you should abandon stocks or cash or pour everything into metal in a panic, because balance and stability matter, especially in retirement. It means you should refuse to let the pain of a paper loss, that doubled ancient ache, chase you out of the very asset built for the storm that may be gathering. Decide which time scale you are truly playing on, so that when the pressure rises, you are Miriam and not Theo. The right decision depends entirely on your own circumstances, and I am not here to tell you what it is, only to make sure you meet what comes with understanding instead of fear. Do not let anyone use this stagflation whisper to stampede you into a rushed move or a costly product, because they will try and they will grow louder. And equally, do not let the ache of a falling price blind you to what the market and the most sophisticated institutions in the world are quietly telling you on the other side of that fear. Those are different errors, and the truth sits calmly between them. None of this is financial advice. In every fact I have cited, the cooling inflation, the slowing growth, gold's jump, the divided Fed, the central bank buying is in the pinned comment, so you can verify every word of it yourself rather than take mine. I opened by telling you that gold rose this morning on news that should have made it fall, and I promised you the single word that explains it. Now you know that word is stagflation, why it terrifies the Federal Reserve more than inflation alone, and why gold is the asset built for exactly that trap. So let me leave you with the question underneath all of it. When the economy slows and prices refuse to fall, and the guardians of the money find themselves with no good move left, do you flee your gold to escape the ache of a paper loss, like Theo, or do you recognize the storm your shelter was built for, like Miriam? The answer costs nothing to decide today, and it may be worth a great deal to have understood before that quiet whisper grows any louder.